Hi everyone, today we are going to talk about money and the banking system. First, let's start with the definition of money. Milton Friedman defined money, that is an asset generally accepted in exchange for goods and services, accepted not as an object to be consumed, but as an object that represents a temporary abode of purchasing power to be used for buying still another goods and services. So in order to define one asset as money, we need to check for the three functions. The first one is medium of exchange. Money is an asset used to buy and sell goods and services. Money is a store of value. Money is an asset that allows people to transfer purchasing power from one period to another. Money is a unit of measurement used by people to post prices and keep track of revenues and costs. For instance, when you say Apple costs $2, that means Apple values $2, so it measures the value to the buyer of buying one apple. Next, let's talk about how the supply of money affects its value. So, as you know, when the demand is higher than supply, prices are higher. So, for the money, the value will be higher when the demand for money is higher relative to its supply. People demand money because it reduces the transaction cost of exchange. If the purchasing power of money is to remain stable over time, its supply must be limited. When the supply of money grows rapidly relative to goods and services, its purchasing power will fall. So how do we measure the supply of money? We have several measures, but the most common ones are M1 and M2. The components of M1 are currency, checking deposits. Checking deposits are like your debit cards, demand deposits, interest earning checking deposits, or traveler's check. As you see, M1 is the most liquid money. That means you don't need to wait to spend that money. It's very liquid. You go to the grocery store and could be able to purchase with the money you have. M2 is a broader measure of money, and it includes more illiquid assets. It includes everything in M1 plus the saving deposits, plus time deposits and money market mutual funds. For instance, when you want to use money in your saving deposits, you have to transfer the money to the checking account, and there are some limitations of withdrawing money from saving accounts over a period of time. If you pass that limit, then you have to pay a fee. So as you see, saving deposits are less liquid compared to checking accounts. Therefore, M2 includes more illiquid assets, so it's a bigger, broader measure of money. You can see here the US money supply. M1 is around 3.1 trillion as of March 2016, and M2 includes everything in M1 plus other assets, therefore is 12.5 trillion. One important point that you need to remember: credit cards are not money. Money is an asset, but credit cards are debt. The use of a credit card is merely a convenient way to arrange for a loan. Credit card balances are a liability, thus credit card purchases are not money. Now let's talk about banking. The banking industry includes commercial banks, saving and loans, and credit unions, and banks are profit-seeking institutions. That means banks accept deposits and use part of them to extend loans and make investments. Income from these activities is their major source of revenue. So banks play a central role in the capital markets, which we refer to loanable funds market. They help bring together people who want to save for the future with those who want to borrow for current investment. So banks provide services and pay interest to attract checking, savings, and time deposits, and these are liabilities of the bank. Most of these deposits are invested and loaned out, providing interest income for the bank. And banks hold a portion of their assets as reserve. They either keep it as cash or deposits with the Fed to meet their daily obligations toward their depositors. So this is called fractional reserve system. Let me explain that. So let's say you deposit $1,000 to the bank, and Fed sets some rules, and let's say Fed set the reserve requirement ratio 20%. So what does that mean? That means $1,000 deposited into the bank, $200, which is the 20%, should stay in the reserve account, and the remaining $800 can be given as a loan. So this makes money for banks because when they lend money, they charge interest rates, and that interest rate becomes the income for the bank. But that $200 is not going to earn any interest rate. The reason Fed set this rule is to make sure that banks can be able to do their day-to-day operations. If somebody goes to the bank and wants to get the money withdraw the money, they should have some money so that they can be able to pay the withdrawal. Sometimes banks keep excess reserve, so this is their reserve account. The required amount, let's say, is 200, but banks can keep 250 instead of 200. So what is excess reserve? Actual reserves in excess of legal requirements. So in this case, $50 is an excess reserve. $200 is the legal requirement and $50 is the excess reserve. And this excess reserve can be used to extend new loans and make new investments. Under a fractional reserve system, an increase in deposits will provide the bank with excess reserves and place it in a position to extend additional loans and thereby expand the money supply. So now the next topic we will talk about is how banks create money by extending loans. So let's see this example. This is person A. Go to the bank A and deposit $1,000. And let's assume that required reserve ratio is 20%. That means $200 needs to stay in the reserve account and $800 can be used to extend new loans. And now let's think about this is person A and now person B gets this loan. Person B can spend this money or can deposit this money into another bank. But in this initial deposit, let's see how much money supply change. We have $1,000 demand deposit, which is M1. Right? Demand deposits is M1 and this guy can use this money anytime he wants. And when we look at the currency, we have $800 now in currency circulating in the bank. So as you see, now we have money supply of $1,800. It's no longer $1,000 and by just lending money, banks create more money. And this process continues because person B can go to here and deposit $800 and bank B should also keep 20% of it in the reserve, but remaining can be given as a loan. So this again another stage of extending new loans. And let's say person C withdraws this loan. And now let's look at what happens to money supply. $1,000 from person A, $800 from person B, and $640 from person C. As you see, banks are creating money by extending new loans. And this process continues until we use all these initial deposits. And here in this example, the total money created is $5,000 with the initial deposit of $1,000. So $1,000 of the money comes from the initial deposit and $4,000 additional money is created through extending new loans. So the lower the percentage of the reserve requirement, the greater the potential expansion in the money supply resulting from the creation of new reserves. The fractional reserve requirement places a ceiling on potential money creation from new reserves. Actual deposit multiplier will be less than potential because some persons will hold currency rather than bank deposits and some banks may not use all their excess reserves to extend loans. So in order to find out how much money is created in the system, we use money multiplier or deposit multiplier. Let's call it deposit multiplier. And deposit multiplier is 1 over R. R here represents the required reserve ratio. In this case, it's 20%. And in decimal form, it's 0.2. So deposit multiplier is 1 over 0.2, which is 5. So what does that mean? That means every $1 deposited into the bank creates up to 5 times of money. So the money supply expands by 5 times. That's why it's called deposit multiplier. And the total money supply will be $5 if $1 is deposited into the bank. And in our case, it was $1,000. And again, R was 0.2. Therefore, 1,000 times 5, $5,000 the money supply, the total money supply through the banking system. The total money supply increased to 5,000 because of new loans that the banks create. And here we say that actual deposit multiplier will be less. It's not going to be 5 than the potential because some persons will hold currency. So remember, person B gets the $800. But sometimes person B only deposit $400 into the bank and spend the remaining. Or person B can just keep the currency at home and never deposit into the bank. And also some banks may not use all their excess reserves to extend loans. Let's say person B deposited $400 to bank B, but bank B keep excess reserves and put this money into the excess reserves and don't create any new loans. If that is the case, again, deposit multiplier will be less than the potential. And here what we have learned is that with deposit multiplier, we know the maximum amount of money that could be created because of the banking system. So in this case, if all new loans is deposited back to another bank, then the banking system creates 1,000 times 5, $5,000 total money. But the initial was already in the system 1,000, so $4,000 of new money is created through extending loan. Now next we talk about Federal Reserve System. The Federal Reserve System, or the Central Bank of the US, created in 1913, and Federal Reserve is responsible for the creation of a stable monetary climate for the entire US economy. It controls the supply of US dollars, and it serves as a banker's bank or bank of last resort for US banks, and it regulates the banking sector. In short, the Federal Reserve is responsible for the conduct of US monetary policy. So let's look at the Federal Reserve System and its structure. You can see here at the top Federal Reserve Board of Governors, and it's composed of 7 members appointed by the President and consent of US Senate. And we have 2 main governing body. First one is FOMC, or Open Market Committee. It's composed of Board of Governors. These are here 7 members. And 5 Federal Reserve Bank presidents. And these Federal Reserve Bank presidents serve in an alternating terms, and New York Bank always represented. And here the second governing body is the 12 Federal Reserve District Banks, and they are actually overseeing commercial banks, savings and loans, credit unions, and mutual saving banks. And this is connected to the public, which represents households and businesses. So now you see on the screen the map of the Federal Reserve Districts. We have 12 Federal Reserve Districts and the cities in which the district banks are located. Each of the district banks monitor the commercial banks in their region and assist them with the clearing of checks. The Board of Governors of the Federal Reserve System is located in Washington, D.C. Now next we are going to talk about independence of the Fed. When we say independence of the Fed, we refer to independence of Fed from political pressure. So what does that mean? Just think about how Fed is powerful first. Fed have the right to print money or destroy the money. So the Fed is controlling the amount of money in the economy. And you know that political party leaders want to affect Fed's decisions. Why? Because when they want to stimulate the economy, that means cheap credits, more money circulating in the economy, they want to put pressure on the Fed, saying that you should not decrease the amount of money. Instead, you should increase amount of money supply in the economy so that people spend this money, so that new jobs are created and the businesses are earning profit. But sometimes this request from the political leader or the president may not actually match with the reality of the macro data. And that request from the Fed may have pressures on the price. And when the prices increase, we have another problem of inflation. High inflation is dangerous for the economy as well. For that reason, Fed or the central bank should be independent from the political pressure, and they should act according to the reality economic data of the country. So Fed independence stems from lengthy terms for the individual members of Board of Governors. Although Board of Governors are appointed by the President and confirmed by the Senate, their tenure is 14 years. So having a 14 years of tenure is actually make these people independent of the political pressure, because political parties, when they are elected, run for 4 years, and for 2 terms, 8 years. However, the impact of lengthy terms may be more apparent than real. Because of the attractive private sector alternatives, the average tenure of Fed governors appointed since 1980 has declined to less than 5 years. And the second thing is that Fed derives its revenue from interest on the bonds that it holds rather than allocations from the Congress. So Fed is not getting money from Congress. Therefore, Fed is more independent in terms of decision making. Now, the next topic is how the Fed controls the money supply. The Fed has 4 major tools it can use to control the money supply. First of all, Fed can set this required reserve ratio. So if it's 20%, that's set by the Fed, and actually Fed can increase this reserve ratio or decrease this reserve ratio. Open market operations, Fed buys and sells government bonds, government securities in the open market. Extension of loans refers to control of loan volume to banks and other financial institutions. And Fed actually pays interest on the bank reserves. So let's learn each of them. Let's start with the reserve ratio. The fraction banks must hold as reserves against their checking account deposits, so that is called reserve ratio. Let's assume reserve ratio is 20%. Then deposit multiplier is going to be 1 over 0.2, which is 5. So every $1,000 deposited into the system, this can create up to maximum of $5,000 of money in the system. But now let's assume Fed decreases this to 10%. Then the deposit multiplier is going to be 1 over 0.1, which is 10. So every $1,000 deposited into the system creates up to $10,000 of money supply. As you see, by changing the reserve requirement, Fed affects the deposit multiplier plus the new loan creation through the banking system. So when the Fed lowers the required reserve ratio, it creates additional excess reserves, encouraging banks to extend additional loans, thereby expanding the money supply. On the other hand, raising the reserve requirement has the opposite effect. So you can see on the screen the amount of required reserve for the US as of March 2016. Up to 15.2 million, required reserve is 0%. Between 15.2 to 110.2, it's 3%. And above 110.2 million, it's 10%. The next tool that uses to control the money supply by the Fed is open market operations. This is the most frequently used policy. It's the buying and selling of US Treasury bonds and other financial assets by the Fed. This is the primary tool used by the Federal Reserve to control the money supply. Remember that US Treasury bonds held by the Fed are part of the national debt. Let's see how this works. Okay, so here is the Fed. This is the central bank. And nationwide, we have lots of banks. Bank A, Bank B, Bank C, and too many banks. Bank C, okay? And each bank has securities. Securities are short-term government bonds. Security, security, and security. So when Fed wants to inject money to the economy, buys government bonds, that means here dollars are going to the banks, right? All banks, right? Dollars are going to the banks. And in return, Feds are buying a piece of paper. Bond is a piece of paper. Okay, that papers are going back to Fed. Okay, here the same idea. So what happens is that the reserve accounts of the banks are increasing. Right? They have more cash, so they can extend the loan. So when there is more money in bank reserves, okay, bank reserves are increasing, the banks do not need to borrow money from each other, right? They don't need to borrow from each other. Why? Because they keep the required reserve. So what happens here is that most of the time, banks are borrowing from each other to keep their reserve account as required by the Fed. And they need to pay interest rate when they borrow money from each other, and that's called federal funds rate. So when you borrow, let's say Bank A borrows money from Bank B overnight, it's a very short-term interest rate, then the Bank A needs to pay federal funds rate for the amount that the bank borrows. And if the bank has a lot of reserves, Bank A doesn't need to borrow from Bank B, or Bank B doesn't need to borrow from Bank C. So what happens, this federal funds rate, it goes down. When people do not demand for loans, in this case banks do not demand for loans, federal funds rate goes down. So by actually buying government bonds, Fed injects dollars to the economy. With that dollars injecting into the economy, federal funds rate, which is the interest rate, drops down. So let's summarize the process. When the Fed buys bonds, the money supply expands, bond sellers acquire money, bank reserves increase, placing banks in a position to expand the money supply through the extension of additional loans. When the Fed sells bonds, the money supply contracts because bond buyers exchange money for bonds and bank reserves decline, causing them to extend fewer loans. So this is the summary of the open market operations. Now the next policy is the extension of loans by the Fed. Historically, member banks have borrowed from the Fed primarily to meet temporary shortages of reserves. So what happens here in this case, Bank A, Bank B, and they're not have enough reserves that's required by the Fed. So they borrow money from Fed, not from each other, but they borrow from Fed. And that interest rate is called discount rate. So the discount rate is the interest rate the Fed charges banks for short-term loans needed to meet reserve requirement. Other things constant, an increase in the discount rate will reduce borrowing from the Fed and thereby exert a restrictive impact on the money supply. On the other hand, a lower discount rate will make it cheaper for banks to borrow from the Fed and exert an expansionary impact on the supply of money. So discount rate and federal funds rate, two different interest rates, but they are connected. The discount rate is closely related to the interest rate in the federal funds market, a private loanable funds market where banks with excess reserves extend short-term loans to other banks trying to meet their reserve requirements. The interest rate in this market, in the federal funds market, is called the federal funds rate. And usually discount rate is either a little bit above or below the federal funds rate. So, announcements after the regular meetings of the Federal Open Market Committee often focus on the Fed's target for the federal funds rate. As I said, Fed meets every 6 weeks, and then during the press release, Fed tells to the public that there is going to be a target for federal funds rate. Remember, federal funds rate is the rate that banks borrow from each other. The Fed controls the federal funds rate through open market operations. Remember, by buying bonds, Fed is actually injecting dollars to the banks, right? To the public. So all dollars are going in return. Bonds, piece of papers, bonds are going to the Fed. This is Fed. And if that happens, the banks do not need to borrow from each other and therefore federal funds rate goes down. So the Fed can reduce the federal funds rate by buying bonds which will inject additional reserves into the banking system. The Fed, on the other hand, can increase the federal funds rate by selling bonds, which drains reserves from the banking system. While media often focuses on the Fed's target federal funds rate, open market operations are used to control this interest rate. Now, the next one is the longer-term loans extended by the Fed. Prior to 2008, the Fed extended only short-term discount rate loans, and they were extended only to member banks. In 2008, the Fed established several new procedures for the extension of credit and began to extend longer-term loans, including some to non-banking institutions. In 2008, the Fed also began making loans to non-bank financial institutions for lengthy time periods. Like the discount rate loans, these new types of loans inject additional reserves into the banking system and thereby exert an expansionary impact on the money supply. And the next policy is interest rate Fed pays on reserves. The Fed began paying banks interest on their reserves in October 2008. Since 2011, the Fed was paying member banks an interest rate equal to the target federal funds rate on both required and excess reserves. The payment of interest on reserves provides the Fed with another tool it can use to control the money supply. So if that interest rate is good, banks prefer to keep the money in the reserve instead of creating new loans. And that decreases the money supply. If the Fed wants banks to extend more loans and thereby expand the money supply, it will set the interest rate it pays on excess reserves very low, possibly even zero. In contrast, if the Fed wants to reduce the money supply, it will increase the interest rate paid banks on excess reserves. This will provide banks with an incentive to hold more reserves, which will reduce the money supply. So you can see a summary of the monetary tools of the Fed. And now let's talk about recent Fed policy, the monetary base, and the money supply. Prior to the financial crisis of 2008, the Fed controlled the money supply almost exclusively through open market operations, which is buying and selling of treasury securities. During 2008, the Fed reduced its holding of treasury securities but vastly expanded its purchases of corporate bonds, mortgage-backed securities, and commercial paper issued by private businesses. In addition to that, there was a huge increase in Fed loans to non-banking institutions such as brokerage firms and insurance companies. And this keeping of different types of bonds in the Fed's balance sheet, that means the Fed is buying lots of bonds, mortgage-backed securities, it's called quantitative easing. This quantitative easing increases in the Fed's asset holdings reflects expansionary monetary policy. Quantitative easing 1, Fed assets increased from $923 billion in mid-2008 to $2.1 trillion in mid-2009. Quantitative easing 2, as the economy remained sluggish, the Fed instituted a second round of quantitative easing. Between late 2010 and mid-2011, Fed assets increased another $500 billion. And the third round, during 13 and 14, Fed asset holdings increased from $2.9 trillion to $4.5 trillion. You can see here the periods of quantitative easing 1, 2, and 3 on the screen. And during the initial phase, quantitative easing 1, the Fed sharply increased its purchases of mortgage-backed securities and extension of loans. In 10 to 14, the Fed vastly increased its holdings of Treasury security. So the first one was the mortgage-backed securities. These are also bonds. And the second and the third one, Fed buys Treasury securities, which are short-term government bonds. The monetary base is equal to the currency in circulation plus the reserves of the commercial banks. The monetary base is important because it provides the foundation for the money supply. The currency in circulation contributes directly to the money supply, while the bank reserves provide the underpinnings for checking deposits. The Fed's quantitative easing policies during 2008-2015 expanded the monetary base from $828 billion in the second quarter of 2008 to $4 trillion in 2015. You can see the screen here, base represented by the red one, M1 is represented by blue, and required reserve plus currency is green. And as you see, since the second half of 2008, the Fed has injected a massive amount of reserves into the banking system, and both the monetary base and the excessive reserves have soared. The next question is, why didn't the banks use the excess reserves to extend loans? Because of the recession and sluggish growth, the demand for loans was big. The Fed pushed the interest rate on Treasury bills and other short-term loans to near zero. There was considerable uncertainty about the future, and therefore banks were reluctant to make long-term commitments. Because of the increased holdings of excess reserves, the money supply increased far less rapidly than the monetary base. And next we talk about the difference between Fed and the Treasury. The US Treasury is concerned with the finance of federal expenditure. Therefore, US Treasury is responsible for issuing bonds to the general public to finance the budget deficit of the federal government. So what US Treasury does, it actually issues a bond. Bond is IOU, so the public buys this bond in return for an interest earning, because bonds are paying interest to the bondholders, and that dollars goes to the government, right? Because they pay money to buy the bond. And that bond, let's say for instance 10% interest rate, that means every year annually 10% paid to the person who holds the bond. And Treasury security issues the bonds to the general public to finance the budget deficits of the federal government, but that doesn't determine the money supply. On the other hand, Federal Reserve doesn't issue the bond, just buys and sells government bonds, and is concerned with the money climate of the economy, is responsible for the control of money supply and the conduct of monetary policy. So when Fed buys the government bonds, let's say here, and gives dollars, that dollars are printed, newly printed money injected to the economy. And Fed actually, when sells government bonds, you see these bonds go to the banks, bank has more bonds, and the dollars that are taken from the system actually destroyed. So new printing money, print money, inject money, destroy the money. So as you see, it affects the amount of money supply. In this case, when Treasury, US Treasury issues a bond comes here, right, public, and dollars go to government. But government actually spends this money back, so this money goes back into the public. So there is no change in the money supply. Money supply stays the same, but when Fed actually buys and sells government bonds, it is affecting the money supply. Finally, we talk about ambiguities in the meaning and measurement of the money supply. In the past, economists have often used the growth rate of the money supply to gauge the direction of monetary policy. Rapid growth was indicative of expansionary monetary policy, while slow growth was indicative of restrictive policy. Recent financial innovations and structural changes have changed the nature of money and reduced the reliability of money growth figures as an indicator of monetary policy. One of the changes, widespread use of the dollar abroad. At least one half and perhaps as much 2/3 of US currency is held abroad. These dollars are included in the M1 money supply even though they are not circulating in the US. Second, people substitute electronic payments for checks and cash. Increased use of debit cards and various forms of electronic money have reduced the demand for currency. Like other changes in the nature of money, these innovations have reduced the reliability of money supply figures as an indicator of monetary policy. So, as a summary, innovations and dynamic changes have altered the nature of money. Economists now place less emphasis on the growth rate of the money supply figures as a monetary policy indicator. Most economists now rely on a combination of factors such as interest rates and growth of nominal GDP to evaluate the direction and appropriateness of monetary policy. So this is the end of chapter 13. Thank you.